I want to say something directly, and I want you to hear it as what it is, an honest assessment, not a performance of pessimism. Most of the crypto industry is dead, not declining, not struggling, dead, in the sense that the projects, the chains, the coins, and the companies that make up the majority of what is called the crypto industry will never recover to relevance, will never solve a problem that matters to the real economy, and will never produce the outcomes that the people still holding them are waiting for. I understand that is not what most people in this space want to hear. I understand it runs against the narrative that has sustained this industry through multiple cycles of boom and collapse. But I have been watching this space for long enough to know the difference between a cycle bottoming and a structural reality asserting itself. And what I am observing now is structural. Let me be precise about what I mean and what I do not mean. I am not making a statement about Bitcoin. I am not making a statement about the legitimate applications of blockchain infrastructure, stablecoin architecture, or the tokenization of real-world assets. Those things are real, they are being adopted, and they are going to matter. I will address them directly. What I am making a statement about is the long tail, the thousands of projects, coins, chains, and communities that exist in the space between those genuine applications and that are sustained not by utility or adoption, but by the collective reluctance of their participants who acknowledge reality. That reluctance is not going to produce a recovery. It is going to produce a prolonged, painful irrelevance. And the people who adjust their thinking now will be positioned very differently from the people who do not. Every healthy industry goes through the same structural process. A genuine technological breakthrough occurs. Capital and talent flood in, creating an enormous number of new companies attempting to exploit the breakthrough. Most of those companies fail, not because the technology was wrong, but because most attempts at commercializing any technology fail, and failure is the mechanism by which capital and talent are freed up to flow toward the attempts that are working. This process is not pleasant. Companies shutting down, projects being abandoned, capital being lost. These are real costs paid by real people. But they are also how an industry matures. The clearing out of the failures is not a malfunction of the system. It is how the system produces concentrated, durable winners from diffuse experimental beginnings. Crypto has never been allowed to go through this process properly. And the reason is structural, not cyclical. Blockchains do not shut down the way companies do. A blockchain can continue to operate as long as a small number of participants choose to run the network. There is no insolvency mechanism, no bankruptcy filing, no moment at which the infrastructure is declared non-operational, and its resources, the talent, the capital, the attention, are formally released to go elsewhere. The result is what I think of as ghost chains, networks that are technically operational, that appear in lists of active blockchains, but that have no meaningful transaction volume, no genuine user base, and no real economic activity occurring on them. Coins have the same problem from a different direction. There is no official mechanism for a coin to reach zero and be declared finished. As long as some small number of people continue to hold it, often because they cannot sell without taking a loss large enough to force the decision, the coin retains some nominal price. It is not dead in any formal sense. It is simply irrelevant, illiquid, and unlikely to recover. What I call zombie coins, not zero, not alive, sustained by the inability of their remaining holders to exit rather than by any genuine belief in the underlying project. Ghost chains and zombie coins together constitute a majority of what is described when people talk about the crypto industry. That alone would make the statement that most of the industry is dead accurate. But there is more to the diagnosis than just the technical failure of clearing mechanisms. The early participants in this industry were, in a meaningful sense, ideologically motivated. They held a specific view of the world, about monetary systems, about institutional trust, about the relationship between individuals and financial infrastructure, and they were willing to accept significant personal financial risk in service of that view. The success of the technology was not merely instrumental to their financial outcomes. It was, in many cases, more important to them than their financial outcomes. These were people who would have chosen to see Bitcoin succeed over personally profiting if they had to make that choice explicitly. That cohort has not disappeared entirely, but it has become a small minority within an industry that has been overwhelmed by participants who arrived for purely financial reasons and who have no particular commitment to any specific vision for what this technology should accomplish. I am not making a moral judgment about financial motivation. Financial motivation is a legitimate and powerful driver of human behavior. The problem is not that people want to make money. The problem is what happens to an industry when the people driving its direction are purely focused on short-term financial extraction rather than long-term value creation. You can see the consequences clearly. Meme tokens that exist solely to generate trading volume before their promoters exit. Product launches designed to capture investment and media attention without any serious intention of building functional technology. Yield mechanisms structured to attract capital through unsustainable rates that cannot persist once the promotional period ends. Constant market manipulation by insiders at the expense of retail participants who arrived believing they were investing in something real. These behaviors are not aberrations. They are the logical output of an industry dominated by participants who have no ideological commitment to building something durable and who are optimizing for the fastest possible extraction of value from the existing pool of capital and attention. When mercenaries outnumber missionaries in any industry, the output of that industry reflects the mercenaries' priorities. The crypto industry's output across the majority of its projects and tokens now reflects that reality. There is a development happening in this space that I think is being widely misread, and I want to address it directly because the misreading has real consequences for how people are positioning. Major financial institutions are entering crypto, not through passive ETF exposure, through direct infrastructure investment, trading capability, and product development. Large traditional brokerages are launching direct cryptocurrency trading. Major banks are building custody and settlement infrastructure. Legacy financial firms with enormous customer bases, sophisticated technology teams, and deep regulatory relationships are moving into the space that crypto-native companies once occupied exclusively. The narrative I often hear about this is that institutional adoption validates the industry, that the arrival of major financial institutions confirms that the assets and infrastructure they are moving into have genuine long-term value. And that is true, in a narrow sense, for the specific assets and infrastructure those institutions are choosing to engage with. But the larger implication is the opposite of validation for the crypto-native industry broadly. It is competition, direct, well-capitalized, regulatory-advantaged competition for the same users and the same assets. A major brokerage launching Bitcoin trading with lower fees than existing crypto exchanges is not a rising tide that lifts all boats. It is a superior competitor entering the market, capturing market share from the incumbents, and demonstrating that the user relationship that crypto-native firms spent years building is not defensible against a well-resourced legacy institution. Watch what is happening to the crypto-native firms in response. They are adding equities, commodities, prediction markets, options, anything that allows them to retain and grow their customer base beyond the crypto assets that their business was originally built around. The implied admission in that strategy is that the original crypto-only market is not sufficient to sustain them as independent businesses. They are becoming traditional financial services companies that happen to have crypto heritage. This merger between the legacy financial system and the crypto ecosystem is the correct long-term outcome for the parts of the industry that have genuine utility. But it is a death sentence for the parts of the industry that only exist because they were insulated from the competition, capital efficiency, and regulatory scrutiny of the legacy system. That insulation is ending. I want to be direct about what I believe has genuine long-term value, because the honest assessment of what is dead is only useful if it is paired with an honest assessment of what is not. Bitcoin occupies a category of its own. Its properties, fixed supply, decentralized issuance, the longest operational track record of any digital asset, and a decade plus of demonstrated security under adversarial conditions, are not replicated by any other asset in the space. The institutional capital flowing into Bitcoin is not flowing into a speculative asset waiting to be validated. It is flowing into an asset that has already demonstrated its properties over a long enough time horizon to be taken seriously by the most conservative capital allocators in the world. Stablecoins represent a genuine infrastructure solution to a real problem: the friction and cost of moving value across borders, across currencies, and across financial systems. The adoption of dollar-denominated stablecoins in particular is happening at a pace that reflects actual utility, businesses and individuals using them to solve real problems rather than speculative demand. The regulatory framework being built around them will accelerate adoption, not constrain it. Blockchain infrastructure, the technology layer that enables the settlement, custody, and verification of digital assets at institutional scale, is being actively built and funded by serious capital, including the legacy institutions I described earlier. The companies building this infrastructure are not speculative crypto projects. They are financial technology companies solving real problems in clearing, settlement, and custody. Tokenization, the representation of real-world assets, from real estate to credit instruments to equity, on programmable blockchain infrastructure, represents perhaps the largest long-term opportunity in the space. The ability to create assets that are programmable, divisible, and instantly transferable without the friction of legacy settlement infrastructure has genuine applications across a wide range of asset classes. This is being built by serious people solving serious problems, and it will produce serious outcomes. These 4 areas will survive. They will be absorbed into the legacy financial system. And when that absorption is complete, they will not be described as crypto. They will be described as finance. There is a dimension of this situation that I think is underappreciated, and it is the one that makes the timeline more urgent than it might otherwise seem. Talent is finite. The best engineers, the most capable product designers, the most effective operators. There are only so many of them, and they have choices. Right now, those choices include artificial intelligence, space technology, biotechnology, defense technology, and a range of other domains where the scale of the problems being addressed and the resources available to address them are genuinely extraordinary. For most of the past decade, crypto was able to compete for this talent pool on the basis of financial upside and technological novelty. The financial upside argument is weakened in an environment where most of the industry's value is concentrated in a small number of assets, and the long tail is being compressed. The technological novelty argument is weakened in an environment where AI represents a more immediate and more broadly applicable technological frontier. If the crypto industry continues to allocate the majority of its attention, capital, and community energy to meme coins, speculative tokens, and projects with no genuine utility, the best people will leave. Not dramatically, not in a single moment of departure, but gradually as they conclude that the most interesting and rewarding work is happening somewhere else. That departure of talent is the final stage of the death process for the parts of the industry that are already functionally dead. And it is also the most important reason why the people who remain in the industry need to be honest about which parts of it are worth their time and capital. I want to close with the perspective that I think puts all of this in its proper context. In the 1990s, people talked about internet companies. They had a distinct identity, a distinct language, and a distinct community. They were separate from traditional business in a way that reflected their novelty and their disruptive potential. By the 2000s, the companies that had survived the shakeout were no longer described primarily as internet companies. They were companies. The internet had become the infrastructure of commerce, communication, and information, and the distinction between internet companies and other companies had largely ceased to be meaningful. The same process is underway in crypto. The assets, infrastructure, and applications that have genuine utility are being absorbed into the legacy financial system. They are becoming financed. The distinction between crypto and traditional finance is dissolving, not because crypto failed, but because the parts of it that succeeded became too important to remain categorized as crypto. What will remain categorized as crypto are the things that cannot make this transition, the things that exist only within the crypto ecosystem, that have no utility outside of it, and that depend for their survival on the continued belief of their existing holders rather than on genuine adoption by the broader economy. Those things are the parts of the industry that are dead, not declining, not waiting for the next cycle. Dead. The honest acknowledgement of that reality is not pessimism. It is the prerequisite for making rational decisions about where to allocate time, capital, and attention. The people who make that acknowledgement now will be positioned to benefit from the parts of this space that will genuinely matter. The people who do not will be waiting for a recovery that is not coming. I want to hear from you in the comments. Where do you see the line between what survives and what does not? And what do you think the timeline looks like for the institutional absorption I described? These questions are worth thinking through carefully, and I read the responses. Thank you for watching. Peace.